we're in this period of time where there's not enough sellers, which typically would lead to higher prices, but we have even less buyers. That's what's happening right now. Is that a good time to buy?
I would say, yeah.
Hell yeah. So if they're on the market, they're likely to negotiate, right? And you have less people you're competing against. What drives prices higher? Scarcity and demand. We have scarcity, that's fine, but we don't have the demand. And so it's a great time to buy.
We've seen the statistics, real estate just doesn't drop, but it's just always that in the back of your mind, like, when are they going to drop? Because I feel like eventually they do.
Well, they are right now, right?
Yeah.
From their highs.
Right.
But if you bought your house 3 years ago, 4 years ago, you're still way better.
Yeah.
In, your value's gone up. Maybe it's not the high that it was, but it's more. That's a really great question, though, and I think that's an apprehension that a lot of people have.
Yeah.
Is, what if?
Yeah.
What if property values go down? Well, first of all,
In life, there's a blueprint for everything. There's no need to start over. Hear from industry leaders, those at the top of their fitness journey, and real estate gurus. They tell you exactly how they did it. All you have to do is listen, learn, and execute. This is The Blueprint with Brad Rice.
All right, everybody, we're back to another edition of The Blueprint, and today it's just going to be Micah and I. We're going to be ripping on the real estate market, talking about what to expect as we get to the end of the year, what's happening with interest rates, how first-time home buyers can get into the market, what's happening more broadly with the real estate transactions, the changes from all the lawsuits that took place over the last year, and what's currently happening with Compass and Anywhere. So some really relevant news for today, the end or fourth quarter of 2025. So yeah, we're just going to get into it. We're going to talk about the things that are important to you guys today, here and now. See if we can't get you to enjoy real estate regardless of where interest rates are at, regardless of where the sales are at, and help first-time home buyers get into their first home. So with that, we'll get started.
Yes, sir. Let's
All
do
right.
it.
We're back.
We're back.
Yeah. So every now and then I like doing this because, it's great to have guests on and have different perspectives and different things and, not only just real estate, but, investment market and STRs and health and all that sort of thing. But, recently you and I kind of pivoted what we've been posting, right? Yep. And so a lot of the stuff that we're posting now is really centralized on real estate and on mortgage. And we're getting some really great feedback. So I mentioned to you that, people seem to be reaching out to me after they see something and they have questions and that sort of thing. And so we're going to do a lot more of that. Not that we're not going to invite, people from different industries in and talk to them and that sort of thing. We'll still do it. Mm-hmm. But I just wanted to kind of get into where we're at with the real estate market today and interest rates and all that, because there are a lot of changes happening right now, and I think people are feeling it. If you're somebody that wants to sell your home, you've noticed a pretty big shift within the last 60 days or so. And I'll put a bookmark there for a second, because a lot of this depends on where you're at, like what area you're in, what state, what city. All the markets are a little bit different, but in general, we all move in a certain direction. So you may have seen some of this slowdown in certain areas, 6, 8, 9 months ago, where it's now just kind of reaching our area in Southern California. So, for example, like if you were in Austin, Texas, you probably saw the slowdown even before that. Inflated prices and, a lot of people going into that city caused, just the valuations to go way up and skyrocket out of control. And they've seen pretty much a collapse in that market, meaning that, when you see an adjustment of 10% or more, that's pretty large. But we're now starting to see that locally. So if you pull up, your favorite app, your favorite portal, if it's Zillow or Realtor.com or Redfin or Homes.com or Trulia, any of those that you get a feed in, and you start looking at a particular city, say you just pull up your city where you're living. So if you're listening to this, you're watching this on YouTube, go and pull up your city in one of those portals that you like, and then just start to look at the existing listings, the current listings, and see how long they've been on the market, and see the price changes they've gone through. Maybe they listed it 4 months ago, 5 or 6 months ago, and then you see a price drop of just a little bit, maybe a month later. And maybe, a month or month and a half after that, they price dropped it a little bit more. And now they've price dropped it for the third or the fourth time, and it's been sitting for 200 days or 250 days. That's what we're starting to see right now.
Yeah.
And I think a lot of this is related to interest rates, even though they've come down. We're at the lowest point the rates have been at in almost 4 years, okay? So rates have really improved, but not to the point where it's getting people that got those super low interest rates in 2020 and 2021 that were in the 2s and 3s and maybe low 4s to want to go, okay, I've wanted to move, but I don't want to give up my low interest rate. But now that rates are down low enough, maybe I'll do that. Like it hasn't gotten that low yet.
Yeah.
But I'll give you some perspective. So on an FHA loan, let's say you're a low down payment. And by the way, FHA loans are not just for first-time home buyers, okay? You can be, but you don't have to be.
Yeah.
But it's a low down payment. You can do as low as 3.5% down. And we'll talk about DPA programs, down payment assistance and all that. But let's just say on an FHA loan for a single family residence, if you've got high credit scores today, without a big rate buy down, like not, we've been using rate buy downs where the seller helps pay closing costs and buys a rate down and get you into something that's a little bit more comfortable on interest rates. But without even that, you're at about 5.25% today. That's really good.
Yeah.
Like that's really, right? That's really good. And I think back, I always, for some reason, a refinance that I did in 2005 always stands out in my mind. I had refinanced my home on a 5/1 ARM, not a 30-year fixed. So it's a short-term rate. You get better rates on ARMs in a lot of cases. We hadn't been in that market for a little while, but we're starting to see lower interest rates on ARMs now. And it was 5.5%. So a 5/1 ARM at 5.5%, but today, 30-year fixed FHA, about 5.25%. And I'm using just kind of your basic parameters, but high credit scores and so forth.
Yeah.
That's really good.
Yeah.
Do you hear that in the market? Do you hear that in the news? Is there any reporting on this? None. So unless you've already made the decision to be in the real estate market, to sell your home or to buy a home, and you start looking at loans, you wouldn't know.
Yeah.
People aren't talking about it. Or unless you follow somebody like me or you're friends with me on Facebook or something like that and you're seeing posts, or you have a mortgage loan officer that you keep in touch with, like you just don't know. And so it hasn't been widely spread. And so we're in this period of time where there's not enough sellers. So we have very, very low inventory, which typically would lead to higher prices, but we have even less buyers. That's what's happening right now. Okay? So is that a good time to buy? What do you think?
I would say, yeah.
Hell yeah. Right? It's a great time to buy. But I'm gonna put a little icing on that cake and tell you, not only is it a great time to buy because of what's happening in the market right now, where you're seeing prices lower, you're seeing sellers. If they're on the market today, a lot of them have to sell for whatever reason. Maybe they're transferred for work or what have you, or they just really want to sell, and they'll make a deal. So if they're on the market, they're likely to negotiate, right? And you have less people you're competing against.
Right.
So what drives prices higher? Scarcity and demand. Well, we have scarcity, that's fine, but we don't have the demand. And so it's a great time to buy. If you're a buyer, you can go out and make offers that you're comfortable with, right? Because these houses are staying on the market longer. And if they've been on the market for 200, 250 days, 300 days, typically those people, they realize they're not going to get what they're listed for. They're not just leaving it there into perpetuity.
Yeah.
And so it's a great time to buy. Here's the thing that makes it better. When I said the icing on the cake, usually the slowest time in the market is the end of the year through the holidays. Well, where are we? We're headed right now to the end of October, which is Halloween. And what does that kick off? Holiday season. Right? Because we got Halloween, then we get into November, we got Thanksgiving, and then we got Christmas, and then we have New Year's. Like, not a lot of people want to go buy and be moving over that period of time.
Yep.
And so it really is a great time to buy. Here's what I hear, though. People say, well, prices are still out of control. And what they don't really understand is the power of the interest rate over the purchase price of the property. And when we end up running numbers, and I'll give a perfect example of this on somebody we spoke to yesterday, when we end up running the numbers and people realize that the lower the interest rate has way more impact than the higher purchase price. So here's a great example. Yesterday, we're talking to a client that wants to buy their first home. Okay, first home, $930,000 or so. Okay, you'd say that's pretty expensive. These are a little older first-time buyers, right?
Yeah.
They've been renting a long time, and their question was about offering a lower price. And believe it or not, this is FHA. We're in that 5.25 range. Okay, great rate.
Yeah.
But they really wanted the payment to be lower. And so when we ran the numbers for them and we showed them how they were better off paying full asking price and asking the seller for a credit for $25,000 to cover all their closing costs and a buy down of the rate versus offering $25,000 less and just paying for their closing costs themselves, it was a no-brainer, right? In this case, for every $1,000 of purchase price, it was only costing them about $7 a month.
Wow.
That's it.
Yeah.
So why would you not just essentially finance the buy down to get a lower interest rate by paying a higher purchase price?
Yeah.
So yeah, you're paying a little bit higher in property taxes. You're paying a little bit higher in insurance, in homeowners insurance, but and a little bit higher because you're financing a larger loan amount. But you're saving your cash, and you're getting a lower interest rate. It was a no-brainer. Once we explained to them, we showed them in black and white what it looked like, it was a no-brainer.
Yeah.
Yeah. So, but it's counterintuitive, isn't it?
For sure, yeah. And they would not have known that unless they, went to a professional.
They would not have known that.
Yeah, it's super counterintuitive.
Yeah. And so this discussion, because, I was on this with one of our other loan officers, I wanted to basically, it was somebody that was referred to me, so I brought a loan officer in to, do the work. But I also wanted to be on the call because I wanted to hear how he reviewed everything with him, and he did a fantastic job. But the other thing that when I kind of chimed in on this is I wanted to talk about the tax benefits. And I don't know if he would have gotten to that or not, but that's a thing that widely doesn't get discussed.
Yeah.
When somebody's paying rent every single month and you don't get any tax benefit from it, and that person paying rent goes, well, I'm only paying whatever, let's say $3,000 a month for rent.
Yeah.
And you're talking to them about a $6,000 a month PITI payment, principal, interest, tax, and insurance, if they go buy something. And they're like, oh, man, I can't, I'll double my payments. I can't afford that.
Yeah.
Until you explain the benefit that they get from the tax deduction. Because guess what? The interest that they pay on their mortgage, and the vast majority of their mortgage payment in the first few years is interest, okay? Figure 80% of it at least is interest.
Yeah.
Your property taxes, and now in 2026, going forward, because of the big beautiful bill, your mortgage insurance is tax deductible. So when you factor in those three things, and a lot of people don't really understand what tax deductions are, but let's just say, Micah, that you're earning $200,000 a year in income, you might be in an effective rate in let's say the state of California, between federal and state taxes, you might be at maybe 39%. Okay, but if you get a tax deduction of those items, the interest, the property taxes, and the mortgage insurance, then those items let's say they equate to $2,000 a month in total, about 39% of that are dollars you would otherwise pay in tax that you're getting back. Now, you can wait till the end of the year and get that refund, a big refund at the end of the year, or you can set your W-4s up so that your net paycheck gives you that money every single month as cash flow and helps you make the payment. So even though you're doubling your rent payment, it really only feels like you're going up $700 a month in rent, right? Because you get that tax break, which gives you additional cash flow to make those payments. Does that make sense?
Yeah, totally.
Okay.
What would you suggest people do? Take it each paycheck, or I mean, if they can afford to do it without each paycheck, then at the end of the year, it would feel like a bonus.
That's a great question.
Yeah.
So let me ask you this. Would you like to give your money to the bank to just hold for you and not pay you any interest, but hold for you and then give it back to you at the end of the year?
No.
Well, that's what you're doing if you're waiting to get your tax refund. So ideally, you'd want to get it monthly.
Yeah.
Get that cash flow monthly, helps you make the payment. Maybe you take that extra amount if you're comfortable making the payment based on what you were taking home before, and maybe you put that away in an investment. Put it toward your retirement,
that's great.
right?
That's great advice.
And so these are the exercises we're going through with people right now. So people think that it's a terrible market, but I'll tell you what, if you're a buyer today, it's a great market.
Yeah.
And the other thing we talk about, what do we talk about with the interest rates?
Date the rate and
marry the house.
Marry the house. That's it.
Yeah. So isn't that a perfect example?
Yeah. I think the thing with purchase price where, if there's a high purchase price, the first thing that comes to my mind is if I'm buying a house at, $850,000 and right when I buy the house, because prices are high right now, say, next year in 2 years, the value of that home drops and at that time I want to sell the house. Say it drops to $100,000, $100,000. I feel like I lost $100,000 because they say, we've seen the statistics, real estate just doesn't drop, but it's just always that in the back of your mind, like, when are they going to drop? Because I feel like eventually they do.
Well, they are right now, right?
Yeah.
From their highs.
Right.
Right. But if you bought your house 3 years ago, 4 years ago, you're still way better.
Yeah.
In, your value's gone up. Maybe it's not the high that it was, but it's more.
Yeah.
So that's a really great question, though. And I think that's an apprehension that a lot of people have.
Yeah.
Is, what if?
Yeah.
What if property values go down?
Yeah.
Well, first of all,
I'd say if you're considering joining the AmeriFund team, it's a really good idea.
We as processors at AmeriFund Home Loans support the loan officers in every aspect of the loan once it comes into processing because we want them out there marketing themselves and originating more loans and supporting more borrowers.
Competitive commission plans are a given, and powerful technology is expected, but what truly sets us apart is our culture. We've built a solid support system for our loan officers.
If you're interested in joining the AmeriFund team, go to amerifund.com/careers.
Well, first of all, you'll only wind up getting a hit if you sell the home, right? So it's just like stock.
Yeah.
If you buy stock high and then you sell it low, you lost money.
Mm-hmm.
But let's say you bought stock high, it goes down, it's low, you're upside down, you're losing money.
Yeah.
It hasn't come back. And then 4 years from now, the stock shoots up.
Mm.
And now it's worth more than what you bought it for. Did you lose anything?
Yeah.
You didn't lose anything.
Yeah.
You only lose if you sell.
Right.
So maybe you don't sell in 2 years.
And you waited.
And what did we look at in the last 75 years? How many years in the last 75 did real estate values go down?
Like, what was it, 7?
7 years.
Yeah.
And what were 3 of those?
The crash.
The crash. Like this anomaly.
Yeah.
The crash of 2008.
Yeah.
8, 9, and 10.
Do
right?
you think a crash like that is destined to happen again? Or, anything could happen.
Anything could happen. I don't think so. And there's a lot of reasons for that. The current values are really based on supply and demand. Mm-hmm. It's not based on bad mortgage paper. So back then it was really bad mortgage paper. It was, Mike, if I could explain to you, and I know that you know a little bit about this now, but the type of people we were giving loans to. So I'll give you a quick history lesson. In the United States, there were two major banks that gave loans based on what they call stated income. For many years, they were doing this. One of them longer than the other. One was World Savings, and the other one was Coast Federal Bank. Okay, they did what we called stated income loans. Nobody else did them.
Yeah.
And it was designed for the self-employed. You had to put at least 20% down. You could not do less than 20% down. You also had to have good credit. Okay. But if you put 20% down, you had skin in the game, right? Even if there was a market fluctuation, you're like, I'm not giving up 20%.
Right.
You know,
Right.
That's $100,000. I'm not going to lose that. So you had the skin in the game. We made sure that you had good credit, that you were likely to make your payments back. And you were self-employed. We would have you state your income on the application. Those loans rarely defaulted. I'm talking about in a less than 1%. It was a minuscule default rate.
Yeah.
Okay, for years and years and years, because they were very steady about how they lent that. You had to have skin in the game and so forth.
So with stated income, they could technically put whatever they wanted.
Right.
And you guys wouldn't look at like bank
No tax
statement
returns,
or-
no bank statements.
It's just what they said.
It's
and
what they said.
Trusted them because they had as much skin in the game as
Right.
20%.
So
Gotcha.
if you're self-employed and let's say your company is making $1 million a year, but you're taking all sorts of write-offs and you're putting your cars through your company and doing this and that, and the reality is you only made $30,000 on paper that year, you're not going to qualify for a loan.
Right.
But you also know you could make the payment.
Yeah.
Because you got the cash flow, you've just been taking the deductions, right? Based on the tax game.
Right.
Okay. So that's why it was designed that way.
Gotcha.
So those loans had a very, very low default rate. But here's what happened. So we talk about why did the market crash and why do I think it's not going to happen again? Well, what happened was Wall Street was really involved in the mortgage market in the early 2000s. And when I say Wall Street, all the big firms, they were doing these derivatives, they were chopping up these loans, they were creating different categories and buckets, and they wanted to keep the volume coming in. And so when it would slow down, they would just open up the bucket a little bit more. And so maybe they had the same requirements, 20% down, 700 plus credit score. Then they're like, well, let's go down to 680. Okay, let's go down to 660. All right, that's still not enough business. Let's do 15% down. Okay, there's still not enough business. Let's do 10% down. And that kept happening to the point where they wouldn't even do stated income anymore. They did no income. You just left it blank. You did no income and no asset. They didn't care where the money came from. And then they did as little as zero down, right? Zero down, no income, no asset loans. Like, you tell me, is that a recipe for failure?
Yeah.
Right? Yeah. So that's where you had your gardener that was buying their 7th home, and you had, your cocktail waitress that was buying their 3rd home and that sort of thing, which all worked fine and dandy when property values continued to go up because they could just sell the property and get out of it.
Yeah.
Right? But as soon as it leveled out and started to go down, that's when the crisis hit. So these people couldn't afford the properties to begin with. They had no skin in the game. That's what happened.
Yeah.
That's not the paper that's written today.
Yeah.
So for many years, it was the tightest paper, meaning that the tightest of qualifications, really dotting our I's, crossing our T's, the down payment, checking the income, checking the assets, just really stringent.
Yeah.
It began to loosen up when non-QM loans came into the picture. That's non-qualified mortgages. So then we started to open up the bucket with different things with, not really, there's, kind of stated income, but bank statements and other things, but still a lot of validation and still down payments, right? And so even though those have loosened up quite a bit, there's still a lot being verified today that were never verified before. And some of that is just because we've come so far with technology and verification of things. But the paper is definitely a lot more solid. When we're making a loan to somebody, we know they can afford it. And there's a lot of tracking of this that didn't take place before. So that's why I don't think we're going to hit a crash like that. Now, that doesn't mean that we're not going to have a 20% pullback in certain markets.
Yeah.
Maybe as much as 25%, in different buckets.
Yeah.
And we're starting to see that, right? That's part of what we're seeing today. But it's not because we're writing bad paper.
Yeah.
It's because how many people had the 2 and 3% interest that don't want to get rid of that house.
Yeah.
That's why.
Who makes the rules? Like who stated, now you have zero, now you can do zero income, or now you can have 0% down. The banks?
Are you a tech investor looking to shape the future of real estate? HomePie is the #1 for sale by owner marketplace, and we are revolutionizing the way homes are bought and sold. I'd love to hear from you. Just email invest@homepie.com and let's chat. Now back to the show. Well,
Who made those, like the federal government?
Yeah, there was a lot less regulation at the time.
Okay.
And so when I say Wall Street, these were big Wall Street investment banking firms that were really designing these products.
Yeah.
And it was really out of greed. I mean,
Gotcha.
there were these traders, and they learned that they could bring this paper in, they could buy these closed loans, and then they could chop them up and resell them in different buckets, and they were making a ton of money. And so because the regulation was so loose, and this was the time of Alan Greenspan, who was the head of the Fed, and they had a mandate. They wanted everybody in the United States to own a property, to have the American dream.
Yeah.
And so it was just a really push from the top, a big push from the top down.
Gotcha.
Yeah, it's a lot different today. So we talked about what typically happens at the end of the year. We talked about the current real estate market. Let's talk about the Fed and interest rate expectations. So the Fed dropped 0.25% last month. The federal funds rate, we talked about that on, I posted some things about what that actually means. That's not mortgage interest rates. In fact, when the Fed dropped that quarter, we saw mortgage interest rates go up slightly. This is when the Fed drops the federal funds rate, that's the rate that banks borrow in overnight trading to keep their liquidity. And so it does directly affect some mortgage rates. For example, Fed funds rate goes down by 0.25%, so does prime rate. So if you have a mortgage that's dependent on the prime interest rate, like home equity lines of credit, you saw your rate come down 0.25%. Okay, so it's percent for percent. But it's not a direct correlation to mortgage interest rates. Now, what we've seen is over the course of the last 90 days or so, rates have slowly been coming down. There's never a straight line, but they've been coming down. We're way better than we were, a year ago even. But we do expect the Fed to continue to lower, possibly more before the end of the year, and then in the beginning of the year as well. So when the labor market tightens, then we've got a reason to have the Fed, believe that they should lower the interest rates, and we're in that market now. So we'll likely see lower interest rates. So as rates lower, what do you think is going to happen to demand for properties?
There's not going to be as much, right?
If rates go lower,
Oh yeah, it's going to be higher.
there'll be higher demand.
Yeah.
Right?
Supply would be lower.
The supply could be lower,
Yeah.
or maybe not. It just
Right.
depends, because if the rates come down enough, do you think some of those people that have a 4% interest rate might go,
Oh,
I'd give up my 4% for a 4.5%,
right. It's true.
right?
Yep.
So we might see a little bit of an increase in inventory as well.
I didn't think about it that
Okay.
way.
So, if we just use recent history, 2020, rates came down, and there was a lot of supply in the market. But demand exceeded supply, and so we had offers on properties, 10, 12, 15 offers, first day, 24 hours. It was just incredible demand, right? Are we going to see that kind of volume? Probably not. But what we might see is 2 or 3 offers on a property. And what is that going to do? It'll shore up the values, at least stabilize them, if not increase them a bit.
Yeah.
And that demand is going to cause you as a buyer to pay more for the property. Now, if you bought the property, let's say today or before the end of the year, and this all happened subsequent, and then rates came down, what do you get? The lower purchase price and the lower interest rate, because just refinance it.
Yeah.
You get the best of both worlds.
Yeah.
So that's kind of what I'm trying to get across today.
Gotcha.
Is really we are in a great period of time to buy property today. So especially if you're a first-time home buyer, like you should really be thinking about doing this. The only way to know if you qualify, I know the prices, they seem high, it seems unattainable, but the only way to know is, what have you learned? What should you do as first step?
Talk to a mortgage broker. Figure out the steps.
Yeah.
Yep. Figure out the path.
They're motivated.
Yep.
They want to get you a loan. They'll figure it out with you, right? And we do this every day. So if you're a first-time buyer, maybe your problem is you don't have a lot of money saved up for a down payment, and you're thinking, gosh, I just would feel so much more comfortable if I put more money down.
Right.
So I talked about a minute ago that this particular buyer we spoke with yesterday, we explained for every $1,000 in purchase price, they were only saving $7 a month. So did it make sense for them to wait and save more money and put more down and then pay more for the property later and have more competition? No. It didn't make any sense.
Yeah.
We're not talking about a big difference. And by the way, that's the total monthly payment, but a portion that's tax deductible.
Yeah.
So maybe only $4 a month of that was actual cost, because they get the tax break on the other.
Yeah.
So as long as, obviously, we're not trying to tell people, how to manage your taxes. We're not tax advisors, but we're just telling you there's certain things to talk to your tax advisor about, and that's one of them.
Yeah.
Right. Great program for somebody that doesn't have much money is that FHA 3.5% down. Now, let's say you don't have the 3.5% down. Can you get a down payment assistance program? Absolutely. Some aren't even driven by income. No income limit. Okay. Some are driven by income. Some are forgivable. Some you have to pay back. So there's a variety of different down payment assistance programs. Some of them depend on where the property's at, and some of them depend on median income, and some don't have any of that at all. Here's the difference. On these down payment assistance programs, you still have a payment associated with them. So we have to take that into account when we're qualifying for the loan. And maybe that makes you qualify for less of a purchase price, number one. Okay?
Yeah.
The other is you may have to pay that loan back at some time. So with FHA, 100% of the down payment, so if you've got 3.5% down, all of that 3.5% down can be a gift. Maybe you got parents that can gift you the down payment. Maybe they've been saving up for your wedding, and they give you the option of, hey, Micah, tell you what, we'll help invest in your future, or you can have one great night for a wedding.
Yeah.
And you say, no, Pops, give me the money for the down payment. I want to buy a house, right?
Oh, I mean, I would do that. I don't know about the
and then
the other party involved, but
well, yeah, you're smart. You're smart. Yeah, you both have to buy into that. But
Right.
hey, you have one, great night in Vegas in front of Elvis, and then you buy a house. I mean,
yeah,
those are just as good of memories,
it's true.
right? So there's options, though. What
Yeah.
I'm saying is that money doesn't have to be yours, and it also doesn't require you to have reserves. So what that means is that a lot of loan programs, when you have your down payment, you have to have money left over in the bank as reserves, sometimes 6 months of payments in reserve. And with FHA, you don't. Okay, so 100% could be a gift. You don't even have to have reserves. So pretty loose, right? And lower interest rates. Okay. So those are things to look at. And like you said, talk to a mortgage broker.
Yep.
And this when I say mortgage broker, obviously it could be a mortgage lender or a mortgage banker. But when I say mortgage broker, I'm talking about an originator that's 100% commission. Ask them that. How do you get paid? Do you get a base salary? 100% commission? That's a motivated individual.
Yeah.
Okay?
Yep.
That's who you want to talk to. What about multi-units for a first home? So buying a duplex or a triplex or a quad. It's not a bad idea.
Yeah.
If you can buy a duplex or a triplex and the rent from the other units helps to subsidize
Yeah.
your unit's payment, or maybe it covers the whole thing, just depending on what kind of deal you get and what kind of rents you can bring in. But let's say that your payment on that purchase is $7,000 a month, but you can bring in $4,000 a month of rent.
Yeah.
It helps you to qualify. We use that income to help you to qualify for the larger purchase price.
I'm curious about that. So, like, say that's what you're going to do, and that was your plan. Like, I'm going to have that exact plan. I'm going to have 4,000 of that 7,000 covered. If you're doing that before the loan, because you guys take that into consideration, like, what happens if, like, you can't fill the unit?
My advice for someone selling their home: number 1, do it yourself and save. Number 2, use HomePie.
HomePie makes it easy to buy or sell without an agent. I can list a home in minutes and start receiving offers right away from buyers.
When we discovered that we didn't have to lose $40,000 in agent commission just to upsize to a larger home, it was an obvious choice.
List your home for free at homepie.com. Keep your piece of the pie.
Yeah, that's a great question. It's a risk.
Okay, just
it's a risk.
Gotcha.
Now, a lot of times with these units, they'll already be occupied.
Gotcha.
And you're just going to wind up evicting, or the seller will evict the person that's in the unit that you're going to occupy.
Gotcha.
Right?
Yeah.
And so they'll already be in there.
Cool.
But yeah, there's a risk. There's vacancy factor.
Right.
So when you're doing this sort of thing, obviously, you want to consider you might have that full payment sometimes. So you want to have some money left over to kind of help you to make that payment if you've got some turnover in there.
Yeah.
You become a landlord, right? And so you need to be aware of that. But it can certainly help subsidize your payment.
Yeah.
And eventually what you do is you rent your unit out and you go buy something else, and that becomes part of your retirement plan.
Yeah. Give me an example of a duplex in Simi, because I'm like trying to think of.
Some cities just don't have.
And Simi's one of them, right?
There's a couple, but there's not many.
Gotcha.
Over off of Sycamore, there's some. There's maybe, I think there's maybe 50 units in Simi Valley that are duplexes, and that's it.
More like in
if you go in the San Fernando Valley.
Oh, San Fernando Valley.
I don't know about Thousand Oaks. I don't know. But you can go online and look up.
Yep.
But when we're talking about duplexes, we can also be talking about single family with an ADU.
Right.
Right?
Yeah.
So you get that income from the ADU that's sitting behind the house. Same thing, right?
Yep.
It's actually a little bit better financing too. You can use that income, but you get financing as a single unit with an ADU as opposed to a duplex that has a higher rate on it. So it's even better.
Yeah.
So that gives you a couple ideas. Let's shift gears for a minute, because there was an announcement 2 weeks ago that was pretty big. And again, unless you're in the real estate market, you may not know what's going on. So there's a lot of mergers and acquisitions that have happened over the course of last year. I'll just name a couple of big ones. So Rocket acquired Redfin. Redfin is, most know it as the app, like a Zillow app, right? That you can search for properties on.
Yep.
But it really was a real estate company. Oh. So Redfin was a real estate company that just had this super app, okay? Rocket acquired them. Rocket also acquired Mr. Cooper. Mr. Cooper is one of the largest loan servicing companies. So when we talk about a loan servicing company, those are the companies you make your mortgage payments to, and they manage your payments, and they manage your escrow accounts for your taxes and insurance, and they're sending you the monthly statements, and they give you the reconciliation at the end of the year and the 1098 and all that. That's mortgage servicing. They're one of the largest. So think about Rocket, giant mortgage company, national mortgage company. They already had Rocket Homes, which is a real estate company, just not real big. Now they acquire the real estate. Then they acquire the servicing, so they've got from cradle to grave. They got somebody looking for a home or selling their home. They got the mortgage, and then they keep them in the family by managing their mortgage and servicing it. That's a big power move, right? Big.
Yeah.
It's a big power move. Is that good for the consumer, or is it bad for the consumer?
Probably not good.
Don't you want competition?
For sure. It's like a monopoly almost.
Yeah.
So,
Would you rather have 3 airlines out there or 23 airlines?
Yeah, right.
You want competition. It's a little scary,
Mm-hmm.
right? So they did that. And most recently announced, Compass is acquiring Anywhere. Now, Anywhere it has a plethora of brands. You got Century 21, you have Caldwell Banker. Gosh, I'm not even going to think of them all, but there's like 7 brand names. under the umbrella anywhere.
Yeah.
Compass is acquiring them. They're going to be by far the largest real estate company out there. By far.
Jeez.
By far. Okay? So, is that good?
Nope.
Well, let me tell you why it's even worse than what you might be thinking.
Oh.
So all these changes, the NAR lawsuits, the decoupling of commissions, where you as a seller just contract with your listing agent, your buyer has a contract with the buyer's agent, and then basically negotiate if they need some help paying the agent commission, so you have the seller pay it. All these changes that took place. Compass came out basically and said we were sold, our industry was sold to Zillow years ago by NAR. NAR gave Zillow the keys to the kingdom by giving them a direct feed to all the MLSs. So Zillow takes all these listings as soon as they get put up on the MLS, they put them on their website. You, as a consumer, go in there and start looking at homes and you say, contact agent. And you think you're contacting the listing agent, but you're not. You're contacting a Zillow agent. That Zillow agent reaches out to you. They're not the listing agent. They engage with you. They hopefully get you under contract. And guess what Zillow gets out of it? 40% of the commission. Biggest referral fee that has ever been paid. They get 40%. Now, they, over some period of time, migrated their business plan into that, okay, and started these referral fees about, 5 or 6 years ago. Previous to that, agents would buy zip codes and get all the leads from that, and they keep, whatever they made. They would just buy the zip code. It was like an advertising sale thing, right? Like Google.
Yeah.
But that's not the case anymore.
Wow.
These are Zillow referrals. Zillow gets 40%. So Compass basically said, that doesn't work for us. We don't want to share our listings with Zillow unless we have to. We want to have exclusive listings. So if you want to see a Compass listing, you've got to go to a Compass website and talk to a Compass agent. Is that good or bad?
I would say probably not good.
Why?
I just think that it shouldn't be like through one individual platform like that. Like you need to come to us and then deal with our agent. I mean, I would say that's probably why.
Okay.
Yeah.
Yeah, I happen to agree with you because if we think back to before Zillow, pre-Zillow, where basically the only people that had access to all the listings were real estate agents on the MLS. So as a buyer, you would call an agent. The agent would go in the MLS.
Yeah.
You didn't have access to those listings. Even when Zillow first started, it was delayed by about a week or so. They would get a feed, but it would be delayed a week. So the agents would have first dibs at it for about a week. But dating decades back, you want to go see properties, you want to know what's on the market, you got to go talk to a real estate agent, okay? But the real estate agent had access to all the listings. Well, now things have evolved a lot. Zillow definitely broke the mold here, and 98% of people want to go and find their own property online.
Yeah.
Maybe at that point they contact an agent, but they want to do the searching without somebody breathing down their neck and, hey, you want to go out today looking around and all that sort of thing. Like they just don't want that pressure. They just want to look.
Yeah.
And they want to do it on their own and they want to do all that. Well, I challenge you. Anybody that's watching or listening to this, I challenge you this. Pick an area, a city that you're interested in. Choose the parameters. You want it to be at least 3-bedroom, 3-bath, X square feet, etc., pool, whatever it is. Whatever those parameters are you're interested in, plug those parameters in a search in Zillow. Do the same thing in Realtor.com. Do the same thing in Homes.com. And whichever platform you want. And then do it in Compass. You're going to find different listings on each one. There's no consolidation anymore. You're going to miss some. If you just have one platform you look at, you're going to miss some. You're not going to see them all.
Yeah.
Right? Does that kind of suck?
Yeah, it sucks for the consumer for sure.
It sucks for the consumer.
Yeah.
So all these lawsuits and everything that are supposed to be pro-consumer and all the regulation that's put in. This is pro-consumer, and we can talk about mortgages and all the changes in mortgages and the Dodd-Frank Act and having an AMC or an appraisal management company so that the lender doesn't have a direct communication with the appraiser, and we're going to protect the consumer. Every single one of these regulations has cost the consumer more money. You know what the average appraisal cost today is? $750. You know what it was before all this? $300.
Over doubled.
And that's just one thing.
Yeah.
We can talk about all sorts of other costs. So what is this going to do? It's going to drive the cost to buy and sell your home up. So you know who made out on this big lawsuit?
Who?
The attorneys. That's it.
Yeah.
Nobody else. The consumer certainly didn't.
Yeah.
Because I predicted this. If you remember when we were talking about the NAR lawsuits when they first started, I said, watch this, Mike. I said, hey, I bet you real estate agents are going to make more money because of this. And you said, well, why?
Yeah.
And I said, because right now, this is before the lawsuits, a listing agent says, well, list your property in a high-cost area. We're not talking about states where they're selling properties for $200,000. You might get a full 6% or even 7% in those. But right now, I said the average in these high-cost states like California, it's 5.5%. I go, but a lot of agents will do 5, and some will do 4.5. I said, but when they decouple these things, and that listing agent goes to the seller and says, hey, guess what? You don't have to pay me 5.5% anymore. By the way, they were splitting that, giving half of it to the buyer's agent, right? You only have to give me 3%. Well, if they were going to do it for 5, make 2.5%, but now they say you don't have to do that anymore. We'll do it for 3. They're making more money, right? That's why I said that was going to happen.
Yeah.
So you know what's happening? Almost all listings are getting a full 3%. And almost all buyer side are getting a full 3%. So it costs more money.
Yeah.
That's what's happened. I knew it. I knew that. And you'll get real estate agents say, well, I'd do it for less than 3%. Yeah, I'm not saying that you won't.
Yeah.
And I'm not saying that it's not negotiable. I'm just saying the average consumer doesn't know that, and they don't negotiate it, and they just accept it. And so we're a victim of all the regulation. And so now let's throw on top of that the consolidation of real estate companies and these exclusive listings. So now you're in this ecosystem where you've got to work with these agents if you want access to these properties. And you as a consumer now have to go, oh man, where am I going to look? I got to look here, and I got to look here, and I got to keep it all organized, and I got to go there, and I got to go there. And now what are you going to do?
Yeah.
You're going to pay more money.
It's ridiculous.
So that's what's happening right now in real estate.
Yeah.
Keep an eye on it. I'll tell you what it's done. It's caused a lot more people to think about the for sale by owner model. Yeah.
Totally.
I talk to people every day about why can't I just do this on my own? Buyer we spoke with day before yesterday is buying a for sale by owner. And then they said, well, I was going to have our friend come in and a real estate agent and be our agent on the buy side. And I didn't bring this up, by the way. And they said, do I need to? And I said, well, I don't know. How comfortable are you in going through the process? If you had somebody to guide you through it like they do, like a transaction coordinator, would you be comfortable with it? Well, how much is a transaction coordinator? $600?
Yeah.
Oh, yeah. No, I'd rather do that than pay 2%.
Yeah.
So
people are smart.
They
work hard for their money, so.
But they're not aware.
Yeah.
Okay.
100%.
And so you have to be aware. So I think that models are going to continue to evolve and change. And just like Uber and Lyft disrupted the taxi and the limo business, they still exist. Taxis and limos still exist, but Uber and Lyft have the majority of the business. I think this shift will be taking place. I strongly believe that more and more people will be thinking about DIY, will be thinking about how can I do this? How can I be comfortable doing it? How can I do it on my own without paying all this money? Because there's 2 types of people in this world. And you tell me which is the majority. There's people that value their money more than time, and there's people that value their time more than money. Which is greater?
Which is greater is time, but most people value money.
Most people value money over their time.
Mm-hmm.
They'll put in the time to save the money.
Yep.
That's right. And so for sale by owner, I think continues to be a growing segment, and we'll see what happens to counter the consolidation that's going on right now.
Mm.
So that's what I wanted to talk about today.
Cool.
Good?
All good.
All right. Well, then let's wrap it up. All right, guys. That was, like I told you, I just wanted to kind of rip for a while about real estate, give you a little glimpse into what's going on in my head, and maybe challenge you to think about things. And I'd love to hear from you. Whether you're watching this on YouTube or listening on your favorite audio channel, or maybe you're seeing a clip of this in your feed, give a response. Like, share, follow. Please, these things help us. If you share this with some friends, it would really help the channel to grow, and we appreciate you. We'll see you next time on The Blueprint.